Have you ever felt like something just isn't right? That feeling when things that are supposed to work one way suddenly start moving in the opposite direction? Well, that's exactly what's happening in the financial markets right now, and the clues are hidden in two of the oldest forms of money, gold and silver. Stick with me, because what I'm about to share is something every single person needs to be aware of. For decades, we've been taught a simple rule. When the US dollar gets stronger, gold and silver prices go down. It makes sense, right? A stronger dollar buys more of everything, including precious metals. This relationship has been a reliable indicator for traders and economists for a very long time. But recently, this fundamental rule has been completely shattered. Let's look at the facts. The US dollar index, or DXY, which measures the dollar's strength against other major currencies, has been on a tear. It's been climbing, showing significant strength. According to the old playbook, gold and silver should be taking a nosedive. But what are they actually doing? They're going up. Gold recently smashed through its all-time highs, and silver isn't far behind, showing incredible strength. This isn't just a small blip on the radar. This is a major deviation from a long-established pattern. So what on earth is going on? Why are gold and silver suddenly ignoring the strong dollar and charting their own course? The answer isn't simple, but it points to some massive shifts happening under the surface of the global economy. One of the biggest drivers is unprecedented buying from central banks around the world. Countries, especially in the East, like China, are buying gold at a record-breaking pace. They are diversifying their reserves, moving away from the US dollar. Think about it. When the biggest players in the game, the central banks, start stockpiling an asset, it sends a powerful message. They're not just hedging against inflation. They seem to be preparing for a future where the dollar's dominance might not be as certain as it once was. This isn't a small-time investor trend. This is a coordinated strategic move by nations. But it's not just central banks. We're also seeing a massive surge in demand from regular people, especially in Asia. In places like China, the real estate market has been struggling, and the stock market has been volatile. So where are people putting their money for safety? You guessed it, gold. They are flocking to physical gold, from small beans to large bars, as a reliable store of value when other assets feel risky. This retail demand is so strong that it's creating a significant premium on gold prices in local markets. Now, let's talk about silver. Silver is often called gold's little brother, but it has a dual personality. It's both a monetary metal and a crucial industrial metal. The demand for silver in industries like solar panels, electric vehicles, and electronics is exploding. We are heading into a future that is more electrified and greener, and silver is essential for that transition. So, while investors are buying silver as a safe haven, industries are consuming it at an ever-increasing rate. This creates a powerful 1-2 punch for the silver price. Supply is struggling to keep up with this dual demand, leading to a potential long-term shortage. What does all this mean for you? This strange behavior of gold and silver breaking away from the dollar is a giant smoke signal. It suggests that confidence in the traditional financial system, heavily reliant on the US dollar, is beginning to fray at the edges. The smart money, from central banks to everyday citizens, is seeking shelter in tangible assets that have held their value for thousands of years. They see the writing on the wall: mounting government debt, persistent inflation, and geopolitical instability. This isn't about predicting a collapse or spreading fear. It's about recognizing a significant change in the financial landscape. The old rules are being rewritten before our very eyes. The decoupling of gold and silver from the dollar is more than just a market anomaly. It's a symptom of a much larger systemic stress. It's a wake-up call to pay attention, to understand the forces at play, and to think critically about how you protect your own wealth in these uncertain times. The story of gold and silver is unfolding right now, and it's telling us something profound about the future of money, the dollar system. Strength on paper, fragility in structure. To understand why gold and silver are behaving abnormally, the analysis must move upstream, away from metals themselves, and toward the structure of the dollar system they are responding to. The perception of dollar strength is central to this discussion, yet that perception is often misunderstood, even among experienced market participants. Dollar strength is typically measured through relative exchange rates. When the dollar rises against other currencies, it is labeled strong. This metric, however, is comparative, not absolute. It reveals how one currency performs within a closed group of fiat systems, all of which are subject to similar pressures: high debt, demographic strain, and political constraint. Outperforming a weak peer does not imply structural health. John Agee's framework distinguishes between exchange rate strength and monetary resilience. The former is visible and easily quantified. The latter is harder to measure and far more consequential. Monetary resilience depends on confidence in long-term purchasing power, fiscal discipline, and institutional credibility. It is here that stress is accumulating. The modern dollar system is anchored not by gold or productivity alone, but by debt markets. U.S. Treasuries function as the backbone of global liquidity, collateral, and reserve management. This role grants the dollar extraordinary privilege. It also creates dependency. As deficits expand and Treasury issuance accelerates, the system requires constant absorption of new debt to remain stable. Rising interest rates were intended to restore confidence by demonstrating policy discipline. Instead, they have exposed a structural contradiction. Higher rates increase the cost of servicing existing debt, forcing greater issuance at precisely the moment when buyers demand higher yields. This feedback loop does not resolve imbalances, it amplifies them. Foreign demand for U.S. debt remains sufficient to prevent immediate disruption, but composition matters. Central banks and sovereign institutions increasingly manage exposure rather than accumulate aggressively. The shift is subtle. Holdings plateau rather than collapse. Duration shortens. Hedging activity increases. These adjustments do not register as crisis, yet they reflect a recalibration of trust. Reserve currency status delays consequences, but it does not eliminate them. The dollar's dominance allows the United States to finance deficits longer than any other nation could. At the same time, it ensures that when confidence erosion occurs, its impact is global. There is no clean exit from a system that's interconnected. This context reframes the behavior of gold and silver. Their resilience is not a rejection of the dollar outright. It is a hedge against policy constraints. Central banks operate within political systems. Fiscal authorities operate within electoral cycles. When debt levels rise beyond what austerity can address, monetary flexibility becomes the default solution. Markets understand this dynamic even when rhetoric denies it. Another misconception lies in the belief that inflation control equates to monetary stability. Inflation measures capture consumer price changes, not balance sheet risk. Even if inflation moderates, debt accumulation continues. Even if growth slows, obligations remain. Stability in this environment depends less on price indices and more on confidence in future governance. The dollar can remain strong while becoming fragile. This is not paradoxical. It is a feature of systems with no immediate alternative. Global trade, commodity pricing, and financial contracts are deeply dollarized. Participants hedge exposure not because they expect imminent collapse, but because they recognize asymmetry. The cost of being early is manageable. The cost of being late is not. Gold's role within this structure is revealing. Central banks have quietly increased gold holdings over recent years, not as a statement against the dollar, but as insurance against policy convergence. When every major economy follows similar monetary paths, diversification within fiat becomes limited. Gold re-enters the portfolio not as nostalgia, but as risk management. Silver, though less prominent at the sovereign level, reflects similar pressures among private actors. Its smaller market size makes it more sensitive to marginal shifts in demand. When confidence hedging extends beyond gold, it indicates that concerns are broadening, not concentrating. For entrepreneurs and business leaders, the implication is not that the dollar is about to fail. It is that reliance on historical assumptions may no longer be sufficient. A strong dollar headline can coexist with rising funding stress, volatile financing conditions, and shifting capital flows. These dynamics affect borrowing costs, supplier terms, and long-term investment decisions. Part 2 clarifies the environment in which the signal emerges. The next step is to examine where this tension becomes most visible, the mechanics of the metals market itself. Have you ever wondered what really moves the price of gold or copper? You see the numbers flashing on your screen, going up, going down, and you think it's all about supply and demand, right? Miners dig it up, factories use it, and that sets the price. Well, that's what I used to think too. But the reality is way more complicated and honestly a lot weirder than that. Welcome to the great divide in the metals market. The physical world versus the world of finance. Let's start with the basics we all know. The physical market. This is the stuff you can actually touch. Think of a mining company in Chile pulling tons of copper ore from the earth. That copper is then shipped to a smelter, turned into pure metal, and eventually sold to a manufacturer who makes wires, pipes, or electronics. Every step in this chain involves real people, real trucks, and real metal. The price here is influenced by things like mining costs, labor strikes, shipping delays, and how many new buildings or electric cars are being made. It's the tangible, nuts and bolts side of the equation. But here's where it gets wild. There is a whole other universe playing with metal prices that has almost nothing to do with physical metal. This is the financial market. Imagine a trader in London or New York. They can buy or sell millions of dollars worth of gold or silver without ever seeing a single ounce of it. They're trading paper contracts, futures, options, and ETFs, exchange-traded funds. These are just promises, digital entries on a ledger that represent a claim on the metal. This market is massive, often hundreds of times larger than the actual physical market. So why does this financial market even exist? Originally, it was for hedging. A copper producer, for example, could sell a futures contract to lock in a price for their future production, protecting them if prices fall. A manufacturer could buy a contract to lock in a price for the copper they'll need in 6 months, protecting them if prices rise. It was a risk management tool, but over time it attracted a different kind of player, the speculator. These traders aren't interested in using the metal, they're just betting on which way the price will go. And this is where the disconnect happens. The price you see on the news is usually the price from these financial markets like COMEX or the London Metal Exchange. And that price is heavily influenced by things that have zero to do with physical supply and demand. Think about it. A change in interest rates by the Federal Reserve, a sudden drop in the stock market, or even just a powerful algorithm deciding to sell. All of these can send metal prices swinging wildly, even if nothing has changed in the real world of mines and factories. The financial world of data and algorithms is often driving the bus, while the physical world is just along for the ride. So, what does this all mean for you? It means that when you're looking at the price of gold, silver, or any other metal, you're not just looking at a simple measure of its physical scarcity. You're looking at a complex blend of real-world fundamentals and abstract financial sentiment. It's a battle between the tangible and the intangible, between physical reality and financial abstraction. Understanding this divide is the key to truly understanding the modern metals market. It's a fascinating, complex dance, and knowing the steps can make all the difference. The preceding analysis leads to a critical transition. Signals have been identified, structural sources examined, and market mechanics clarified. Part 4 addresses the question that ultimately matters to decision makers: how these dynamics translate into real-world business risk. This is not a discussion of asset allocation or tactical positioning. It is an examination of how monetary fragility alters the operating environment. For firms and entrepreneurs, currency stability is often treated as a background condition. Contracts are denominated, debt is structured, and cash flows are projected under the assumption that the unit of account will remain relatively predictable. When that assumption weakens, even modestly, risk migrates from the financial periphery into core operations. One of the first transmission channels is financing. Rising interest rates are commonly interpreted as a temporary cost increase. In a structurally strained system, they become a filter. Credit does not simply become more expensive, it becomes more selective. Lenders tighten standards, shorten maturities, and reassess collateral quality. Businesses that relied on continuous refinancing face compressed timelines. Entrepreneurs who built models around abundant liquidity encounter a different landscape entirely. A second channel is contractual risk. Long-term agreements assume stable purchasing power and manageable volatility. When monetary uncertainty rises, counterparties seek flexibility. Price adjustment clauses become more common. Renegotiations increase. Disputes emerge not from bad faith, but from misaligned expectations formed under a different regime. Firms within margins or rigid cost structures are disproportionately exposed. Supply chains represent a third area of vulnerability. Globalization optimized efficiency by minimizing buffers. In a stable monetary environment, this approach reduced costs. Under stress, it increases fragility. Currency volatility, funding disruptions, and hedging costs affect suppliers unevenly. Reliability, not price, becomes the binding constraint. Businesses that lack redundancy discover that risk was merely displaced, not eliminated. For entrepreneurs, the greatest danger lies in misinterpreting calm markets as stable systems. The analysis presented does not argue that collapse is imminent. It argues that the margin for error is shrinking. When margins shrink, strategies that depend on precise timing, leverage, or continuous growth become fragile. Optionality, having the ability to adjust without forced action, gains value. This does not imply hoarding liquidity indiscriminately. Liquidity itself carries risk when its value is uncertain. Rather, it implies a hierarchy of resilience. Balance sheets designed to absorb volatility outperform those optimized for peak efficiency. Flexibility in financing, sourcing, and pricing becomes a competitive advantage rather than a cost. Another critical implication concerns information lag. Official data reflects past conditions. Market signals reflect current stress. Operational realities reflect future outcomes. Businesses that rely exclusively on lagging indicators will respond too late. Monitoring indirect signals, credit spreads, inventory behavior, settlement terms, provides earlier insight into systemic shifts. The metals market, as explored in earlier parts, functions as one such signal. It does not dictate action, but it informs perspective. When monetary hedges decouple from conventional models, they indicate that assumptions embedded across the economy deserve re-examination. What should be avoided is reactive behavior. Chasing narratives, over-adjusting to headlines, or adopting extreme positions introduces unnecessary risk. Strategic response requires proportionality. It requires distinguishing between noise and structure, between cyclical fluctuation and regime transition. The most effective operators in uncertain monetary environments are not those who predict outcomes precisely, but those who remain solvent, adaptable, and informed across scenarios. They recognize that systems rarely fail cleanly. They degrade unevenly, creating pockets of stress and opportunity simultaneously. Part 4 completes the translation from macro signal to strategic awareness. The final part will synthesize these insights into a coherent framework for thinking about monetary transition, without prediction, without alarm, and without reliance on outdated assumptions.